Well, good morning, everyone. Everybody had a great celebration yesterday with Father's Day and the weekend. Thank you for attending this morning. We've got some exciting stuff coming up here, so I'm going to give a brief introduction, go through some items as we do have a diverse audience here, and get everything set up. But again, my name is Justin Ford. I am a sales director for life and annuities here at IMES, and we're going to be covering this morning a little bit before we get started some features with IMES. We've got a diverse audience with us here, and we're going to be covering some material that will affect both of you. We've got some new individuals with us on the call, and we've got other individuals that have been licensed with us for some time. We certainly appreciate both taking the time today. One of the things we're going to start off with, because it's Monday, and because I said we're going to talk about cash. So we've got a couple ways to get you some more, make even more money for you that we're going to be covering this morning. Whether you're new with us or you're just getting your start, or you're an existing producer with us. We'll start off with new producers to help incentivize your launch with us during the first 180 days after you've licensed with us here at IMES. One, we'd like to give you an opportunity to jumpstart your business with us, get a real feel for submitting an application all the way through commissions paid to really incentivize you to get started sooner. We've found, and as I'm sure you have with your clients, that that's the best way to get a relationship started so we can get everything worked out and see how our system works. And to do so, we're going to pay you for it. So to give you an example, these are annuity premium amounts up on the screen here. If you have interest, we'll send over to you the life amounts as well, and the single premium life, which we're going to be talking about this morning here with OneAmerica as well. But $100,000 in submitted annuity premium during your first 180 days, once it goes paid, be $10,000 in life, would get you an opportunity to either choose between a 1,500-piece postcard mailing, an iPad, $750 in cash, or our marketing analysis and corporate identity package or branding package. All the way to the other end of the spectrum here, you can see the levels in between that goes up even further in the $1 million premium level during that 180 days, customized videos, preset annuity appointments, and a complete branding package pushed out through news outlets such as ABC, Fox News, NBC, dinner workshop as an example. And if you're doing a system that gets you in front of your particular type of ideal prospect or client, we're open to shifting some of those funds over to that and covering one of those programs for you as well. So it doesn't just have to be in here. Those of you that are on the call, some of you may have actually come to us through our referred producer program. Those of you that are on the call that have referred folks over, we appreciate that very much. We're going to pay you for those. So when you do have an individual that would be a fit with our organization that would like some assistance, you submit them or request them to a referral over to your primary contact here at IMES. And once we get that individual contracted, my team and myself will reach out to them. Once they get licensed, we give you $50. And then that referral out of our pocket, not theirs or yours, you're going to get paid thousands. You're going to get paid basis points on their production from the beginning of their start with us here at IMES all the way through your partnership with them. So you'll get paid on the business, not out of their pocket, out of ours. And in addition to that, we have a marketing reimbursement program for those of you that are with us here. And as you write, this would go on top of the referred producer program. But as you write business with us, we're going to pay you $100 in marketing reimbursement per $100,000 of indexed annuity premium, $200 per $100,000 of single premium life, which we're going to be talking about here a little bit with OneAmerica, and $200 per $10,000 in target premium for our life insurance as you go forward. And that can be used to utilize many of our services here or vendors as it relates to getting new prospects or an enhanced branding or talking to existing clients through your own marketing program. If you have an interest in any of those programs, please by all means talk to your business development director today. We can get you all set up there. As you do start new business with us here, we're going to be introducing you to our back office support and staff. One of the key reasons many people join IMES is because of our service level agreements and our service level and our expertise in that area. We do still have the 2-call guaranteed live person pickup. None of us have individual phones so that you can reach out to us and get a live person every time. And that goes further into the rest of our back office support. Those who process your casework, do the pre-underwriting, work with you on getting illustrations, designing a case. These are all things that we're here to do for you and help you support your practice. On our website, we'll be talking about that here in a second. We're going to go through further business building tools and resources, as well as how you can access our paperless contracting. Before we do that, when you do take an application with us, we are a partner with Firelight as well as IGO. Firelight being primarily the site to launch electronic applications for your annuity business. Several carriers on the life side utilize Firelight as well. If you haven't registered for Firelight just yet, it's as simple as letting your primary contact know, shooting me an email, or via our website. You can apply just by clicking on e-applications and then Firelight to register for Firelight. Benefit of doing so, applications come in with no or very limited, not in good order applications, and your business gets paid quicker. I've had a case pay within 24 hours. It was a cash case from annuities going through Firelight, and it's that type of thing that we appreciate nowadays. Instead of filling out paperwork and having issues and running into challenges when the company changes the forms, you don't have to deal with that with Firelight or IGO. IGO is also located in the same location on our site, and that can be accessed to write term applications and the majority of our life insurance applications here. We are bringing on more and more companies as they start to join with Firelight, and if you have a question, just let us know about the carrier that you work with, and if you'd like to register, we'd be happy to help. Our creative marketing solutions team, when we take a look at client engagement assets that we have, you have access to working with our creative team that does everything from social media, increases social media. Maybe you have an interest in adding your branding to social media or enhancing your presence or even starting a presence. They can help you with that. Digital solutions, everything from a personal website all the way through email dripping campaigns, online newsletters, etc. Everything from the simplest logo design or business card all the way through fully customized video and commercials, etc. So we can assist. If you have an interest in this, please let your primary contact at IAMS know today. And again, via our website. So on our website, there really is some significant value on our site. Not only can you run term insurance quotes and guaranteed universal life quotes and take an application right on the spot using IGO, you can also get annuity quotes. What income benefit rider is going to pay out and have the top payout 1 through 300 of products in the industry. What multi-year guaranteed annuity is paying the best rate on a 3-year MIGA. These are all things that can be accessed through our website. And maybe it's after hours and you need a form, whether it be an in-service form, a beneficiary change form. You can access the forms from all the carriers on our site, as well as get updates on news, pull our forms, as I mentioned before, and it's always accessible. So if you have a question on estate planning or buy-sell agreements, we also in the marketing section under sales tools have a great resource where you can type in everything that you're looking for, and educational material will just be at your fingertips. When it comes to working with the client on the front end, we also partner with Retirement Analyzer, who can take a client's idea of how retirement's going to work for them, what accounts they're going to use, what forms of guaranteed income they have, like Social Security, maybe a pension, and it allows them to put their budget in and take a look at if the plan they believe to be true today were to come true tomorrow, would it work out or not the way they'd like it to? And of course, when it does not, we've got an advisor like yourself there to assist them. This is a fully developed program. We've been partnering with Retirement Analyzer for some time, and if you have interest, let us know today when we reach out to you or your primary contact at IAMS. As well, we partner with Stonewood. Stonewood is a program that will allow a client to take a look at the difference between paying taxes while paying taxes in retirement versus paying taxes today when it comes to life insurance. That program is responsible for increasing target premium in the area of indexed universal life, and we'd be happy to speak with you about it as well. if you have an interest in IMS Wealth Management, if you're looking at getting your 65, have an interest in investment management, or maybe you're already a investment advisor rep and you're looking for an insurance-friendly organization that recognizes the sale of premium with life insurance, annuities, and your wealth management, you're looking for a change, give us a call. Let us know. We can have Duncan reach out to you on the team here, help increase your wallet share, your relationships, and your retention with clients as we move forward into the new year. We have brought back our 2-year training academies for those who have interest. We just finished up one last week. We had a little slowdown with the pandemic. That has alleviated itself. We're putting together a different set of upcoming trainings and dates. If you have an interest, please let your primary sales director here at IMS know, and we'd be happy to get you on the list, let you know about the dates coming up. Have our upcoming trip here. We do an annual trip, or trip coming up is going to be in Greenbrier. Our qualification period is a little different compared to other IMOs. We do 18 months versus 12. And we also have different levels of qualification. As an example, if you had landed within the top 20, you and a guest would spend 3 bonus days in Washington, D.C. on this trip. And before joining us here at the stately Greenbrier Resort. Top 3, you and a guest would stay on property in a spacious luxury cottage and then move on to the Greenbrier Resort. So we do have options there, and qualification period is 18 months. We are on social media. Feel free to follow us. And that's my skit. I'm going to introduce Brent DeGroot from OneAmerica and get you switched over here, Brent, and let us start with the main show today.
Well, thank you, Justin. Appreciate that. And sounds like we've got some new producers on here today, so welcome. I will welcome everybody, obviously. And I want to get my screen up here and pull up the presentation here. Let's get this going. I'll probably have to switch this really quick. All right, that should do. Well, again, very, happy that everybody's here today. Happy Monday to you. And really, I wanted to talk to you about some exciting things going on here at OneAmerica and really cover 3 opportunities that I think are really big planning solutions for you when planning for long-term care with your clients. So without further ado, I do want to give you some insight into who OneAmerica is. We are one of the asset-based leaders in this long-term care planning space. You know, the long-term care market has shifted over the years, and really seeing more and more consumers really lean towards and purchase the asset-based type of solutions for planning for long-term care. And that's all we do here at OneAmerica is these asset-based type of solutions. We can trace our roots back to 1877. We're A+ rated. Current Comdex score is 95. All that speaks to our financial strength. As I said, we were one of the first to market these asset care or asset-based solutions, which we call Asset Care. As a matter of fact, we sold our first plan through one of our subsidiaries, Golden Rule, back in 1988. So year I graduated from high school, so I'll never forget that. But we've also got an annuity chassis as well, and that we sold our first plan back in 1998. So 10 years later, we came out with the annuity side as well. And then we are a mutual company, so I really wanted to make sure that you understood that we are a mutual company, which means we're owned by those same policyholders that buy policies with us. So that's who we report to. We're always thinking in terms of, how is this going to affect our policyholders? Because, again, essentially that's who we report to. So, with this long history in this asset-based market space, almost 35 years now, we've got a lot of history with designing plans, administering plans, filing plans, and most importantly, paying claims. And when you're a mutual company and you're focused on your policyholder, that is something that is vitally important to us and that you can impart to any of the consumers that you work with. So To start off today, I will say this before I get into kind of the concept of our solutions. I do want to mention that we had recently a price decrease, and you don't hear that in the long-term care planning space very often. So yes, I did say decrease, but as of May 26th, we actually decreased some of our rates on our life chassis, which we call asset care. That's about 70% of our business. The other 30 is annuity care or our annuity care suite. So, and that's on our annuity chassis. So a rate decrease on our life-based chassis, which we call asset care. And it's anywhere from 5 to 15%, kind of depending on the package that they would end up choosing. So really happy to announce that price decrease. So with that, I do want to talk about the concept of our solutions on this asset-based planning side. And really it starts with a base policy. So if you've ever seen any of our information before, I know I've heard from some when I'm doing this live and in person, people will come up to me and say, I really like the concept that you guys have, but you've got a lot of moving parts in it, and it seems to be a little overwhelming sometimes. So I really wanted to simplify that as much as possible. And if you can get this concept, which I've got here on the slide, you understand our plans inside and out. Now, yes, we can still custom design and really tailor make a plan specifically for each one of your clients. We've got lots of ways to put these plans together, but it really starts with this concept, and it's just base policy, which is either a life insurance policy or an annuity. That is a base policy that the client will own themselves, and that's their asset, right? So that's what they're going to invade first for any long-term care needs. But then we have the ability to add a rider, and that rider is a continuation of benefits rider. So if you think about this, if they first invade their base policy, whether it's a death benefit or the annuity value that's in that base policy, they would spend those dollars first for any long-term care needs applicable. Once that base policy is exhausted, the rider would kick in and continue to pay that same income stream specifically for those LTC expenses for as long as we have options to pay for a lifetime. So as long as either one of them could live. So understand this concept right here, base and rider, base and rider. And now you've got OneAmerica in a nutshell. Now, one of the biggest things that differentiates us from our competition is the fact that we have that lifetime benefit option on the continuation of benefits side, that COB rider portion. But if you look at kind of how this is all structured, essentially what we're doing is repositioning a portion of their portfolio. Whether that's cash in a bank, so creating a new premium, whether that's just repositioning a portion of their portfolio to create an asset specifically used for long-term care expenses, and that's exactly what we're doing here. So we just take a very well-balanced portfolio, as you can see here, create a base and rider plan, and have the option to cover two people even for a lifetime of expenses. So really separates us from our competition, the fact that we have a joint policy structure, essentially a joint second to die life structure, if you will, and then that lifetime benefit. That really gives people true peace of mind. Now, when you're planning for long-term care, the other things clients always look for is guarantees, right? They want this money to be safe. And what we've got here with our planning solutions are all guarantees built into these plans. Guaranteed cash value, guaranteed death benefit, guaranteed long-term care premiums or income streams amounts that are available for them for any care needs. And then the premiums are all guaranteed as well. So there's never going to be an increase down the road. That's never a call you really want to take from your clients. Why am I getting this price increase? So just know these are all guarantees built into these types of plans. Now, Where it starts to get a little confusing for some people is the fact that we can take a variety of funds to really create the plan. But again, if you remember, base and rider, IMS is here for you. We here at OneAmerica are here for you, and we can really help tailor design any type of plan. But again, many ways to fund these types of plans, whether it's just cash, whether it's life insurance cash values that they maybe no longer need. We can do 1035 exchanges. We can create recurring premiums. For the longest time, these asset-based structures were only a single premium. And now we actually offer a recurring premium structure, which I'll touch on at the very end of this presentation as well. So we understood that not everybody had the ability to just reposition a single premium. And so we created some of these recurring premium strategies. But the next two are ones that I'm really going to highlight in today's presentation, and that's using qualified funds. And most consumers don't understand that, and many advisors don't understand that you can use qualified funds to create a long-term care plan. And we've got a great solution here at OneAmerica, and I'll talk about that here in just a minute. And then using non-qualified annuities. I think this is probably the biggest opportunity that many of us advisors overlook. So I'll get into that one here as well. I wanted to pull this out of a one-pager that we have because I like the fact that we put this all in one kind of nice grid that just shows, hey, I've got this source of funds. What type of solution can we put together? So nice little grid here, just check box on any types of the plans that we have available and how to fund those. So I just threw that slide in there, and we can follow up with this marketing piece after the webinar today. So let's get into kind of a couple really big opportunities for you here. And the first one is through our asset care solution, which is our life-based chassis. But we're actually using qualified funds and putting it into an annuity. So it's called asset care annuity funding. But I like to just say, think of this as the qualified solution. Now, it is a single premium that's funded by an annuity. That annuity then pays over 10 years to fund a base and rider 10-pay policy. And I'll show you that structure here in just a little bit. So pretty straightforward there. But you can see the issue ages here, and I want to point this out. Now, remember, we're using qualified funds, right? So the reason we have the issue ages here, 59 and a half up to age 80, is that we don't want anybody to use qualified funds under 59 and a half and incur a penalty, that 10% penalty. So that's why we put the limitation here of 59 and a half up to age 80. We can actually quote starting at 55. There's ways that they can still put this scenario in place and pay for those years up front until they reach 59 and a half, and then get that premium reimbursed to them on the back end. But again, just really think about this as a 59 and a half plus solution. So how do we typically fund these? We see them from IRAs, 401ks, 403bs. That's really the funding source. So again, most of your qualified scenarios are what we're funding this with. So why use qualified funds? Well, it's good for both the consumers and for you as an advisor. So the consumers, we can really use one person's retirement dollars to create a long-term care plan for any of these individuals. We can utilize those idle dollars that are just sitting there in those, and then we can spread out the taxation over the 10 years. Now, I'm going to come back to this RMD and inherited IRA situation, but just know that we can do that as well. For producers, look at the market. We can see 8.8 trillion in amounts of money that are available for the market here. So just wanted to make sure that you saw that we had this option available and just how vast that marketplace really is. So a really great way to work with your clients around these types of solutions. All right, so I wanted to get into just a couple quick scenarios here. So we've got a hypothetical here that I wanted to show you, and it's basically a male and female that we're going to be creating this scenario for, both age 60. So over that 59.5 threshold, so that's a good thing. I'm going to call it her IRA. So she's got an IRA worth $200,000 here, and really wanted to use that for their long-term care planning. So we take a direct trustee-to-trustee transfer, direct from her current IRA holder, and put it into a qualified annuity here at OneAmerica. Right off the bat, we're going to give that amount a 20% bonus. So since we're using $200,000 here, obviously that 20% bonus would be $40,000. So great little way to bonus this scenario for putting their long-term care plan in place. Now, what we do then is use that now $240,000 to fund a 10-pay base and rider plan, right? So we're going to break that $240,000 into 10-year annual distributions funding that 10-pay base and rider plan. What I want you to understand, this is a qualified solution. So while it sits at OneAmerica with no taxation because it was a direct trustee-to-trustee transfer, that annuity then will feed over the 10 years to a non-qualified scenario. So there will be taxation that happens on that 10-year distribution. So those 10 years that your clients will get a 1099 for whatever that distribution happens to be. And I'm going to come back to that in just a little bit here as well. So in this particular scenario, obviously that $240,000 becomes 10 equal distributions of $24,000 each to fund that 10-pay base and rider plan. So I liken this to I'm drawing a blank on what these things are called now. But the hourglass. Thank you. There it comes. Finally came to me. So I put that one on there really quickly for you, just as a visual. So if we looked at what this created, so we had that $200,000 coming over as that single premium annuity. We're going to leverage that right off the bat and create a face amount of $239,000, almost $240,000. So we leveraged that $200,000 they originally gave us in the terms of a face amount or the death benefit that would be usable for long-term care expenses. But remember, we give it that 20% bonus right off the top as well. So we put an extra $40,000 into this account. We have those $24,000 increments then over 10 years. Again, remember that would be taxable to your client in those 10 years. That LTC 1099 will come to them. So if you're doing any tax planning, or even if you're not, you just need to be aware of that. But look what this creates for this wonderful solution. So $71.85 as a monthly benefit for long-term care expenses for as long as either one of them could live. If we looked at that as an annual, that's $86,220 per person. And again, as long as either one of them would need care. So what a great little solution here when planning for this. Now, I wanted to quickly show you what the output, the quoting output looks like here as well. I get a little questions around this initial premium, $24,000. Well, I thought we gave you $200,000. Why is it only $24,000? Well, remember, what we're showing here is the initial premium to fund that base and rider plan. So it's really just the $24,000 that it will be that 10-year premium. So that's what we're showing here. Now, again, we're going to show the face amount just below that. So nearly $240,000 is a face amount for this asset care plan. Just below that, we show kind of our timeline. So a face amount payable for LTC would be that whole nearly $240,000. If they exhaust that benefit, that is when the continuation of benefits would kick in and continue the same income stream per person for as long as they would ever need care, for as long as they live. So $71.85 per person. It would pay double if they both happen to be on claim at the same time. It would pay $14,370 per person. That's just paying down the face amount quicker. So just realize that. But again, they've got the lifetime benefit structure. It doesn't really matter. As quickly as they exhaust their face amount, that continuation of benefits rider would kick in. A couple things I wanted to point out here. We always break out the LTC premium. And the reason for that is because LTC premiums can be tax deductible depending on how your client files for their taxes. On an individual basis, we don't see that very much because the standard deduction has become so high. That plus they've got to itemize, they've got to show an adjusted expenses over and above a 7.5% adjusted gross income. And so it takes a little bit more to jump through those hoops. Where I really see this coming into play is for all of your business owner clients. So those that are pass-through entities or C Corps, this is a wonderful scenario for them. They run these through the business. If they're that pass-through entity, and I'm going to oversimplify it here, but if it's their pass-through entity, they can essentially take whatever age that they fall on the age-based caps and take that amount of the LTC premium as a deduction. So the IRS puts out these age-based caps every year. They're 10-year age bands, and that's the amount that they could take. So it may not be the full $11,230 here, as we're showing, but it's still some portion of a deduction. Now, your C Corp clients can take the whole deduction. They take the whole premium amount for that. So if you've got C Corp clients, really any business owner client is a really good scenario. So I wanted to point that out. Another thing I wanted to point out here, under the features and benefits, it'll show waiver of premium. Any recurring premium situation, and this is a 10-pay, so this is a recurring premium situation. We've got waiver of premium that is built in. Meaning if I flip over here to the ledger page, I'm going to show 10 years of payments, right? But let's say that in year 7, one of those clients goes on claim. Well, waiver of premium kicks in. So while the life plan then is on waiver, so no premiums due, this particular distribution will still happen from the qualified annuity, but it can go directly to then the clients, and they can use that extra for any care needs that would arise. So something to really kind of show there, if you will. I wanted to quickly talk about that, but you can see the total benefit balance is unlimited. You've got your monthly benefits all set at the $71.85. Okay, so why annuity funded whole life? Well, the majority of us, in the U.S. are saving in qualified scenarios, right? I used to use this one a lot before the downturn really happened, but harvest some of the melt up. We were on the longest bull run in history. Harvest some of that before the downturn happens. Well, the downturn certainly has happened. Remember, these are all guaranteed solutions. So really still a good reason to use qualified funds to create a guaranteed plan for them with guaranteed, all guarantees built in. We've got that 20% bonus right off the bat for any amount that they put over. We spread that taxation out over 10 years. Those distributions, if your clients are the age of majority, so 72 or greater, they are RMD friendly. We know that many of the clients that use this type of solution don't need their RMDs necessarily for income needs, or are looking for ways to satisfy some of those RMDs. So those distributions are RMD friendly, can count towards that RMD calculation. So good thing for you to know there. Again, remember, we've got waiver of premium built in on these policies. And then the last thing I'll mention here with this particular scenario is that inherited IRAs. You may not run into them every day. However, the new Secure Act rules say that any non-spousal inherited IRA must be drained in 10 years. So this particular solution works extremely well for that. And oh, by the way, the Secure Act says if they're under 59.5, there is no 10% penalty. So a great way to work with any of your clients on any of those inherited IRAs as well. So now, qualified funds, can we use that with annuity care? I told you we had two different platforms, both our life chassis and our annuity chassis. I will say this, yes, we can use qualified funds with annuity care, but any of the gain in that annuity will be taxed in those distributions. So I don't really suggest that. I really like the life-based chassis, our annuity funded whole life there. But I thought I would just mention that you can still use qualified funds with annuity care as well. So how about California? I'm not sure if we've got California on here. Unfortunately, we can't use qualified funds with annuity care in California. And I will also say this, that same solution that I was just talking about with our life-based chassis asset care, the annuity funded whole life, works a little differently. In California, we spread that taxation out over 20 years. So it's just a little different plan. We've been filed with the state for quite some time. Hopefully we're going to get that update here shortly, and it will all be the same in all states. So California, we still have a solution to use qualified funds. It works just a little bit differently. So let me show you a better way to fund the annuity platform, if you will. And first and foremost, let's look at some annuity statistics here. You know, it's a huge market as well. Maybe not quite as much as the qualified funds that people are using to save out there. Excuse me. But still a huge, huge market. So think about the annuity marketplace in and of itself. You know, your clients buy those annuities, those non-qualified annuities, for a variety of reasons. And really, they usually fit into one of these four categories: growth, tax deferral, guaranteed lifetime income, or, you know, really additional benefits to guard against a catastrophic illness, essentially long-term care, right? Now, I say this, lots of times those non-qualified annuities in your client's account are kind of sitting there on the sideline. They've had these for years. There's lots of embedded gain in them. They don't want to touch them. That's their what-if money, their safe fund, whatever you want to call it. And lots of times, if you ask them, okay, so what would constitute, or what would make you trigger or use that non-qualified annuity that you've just got sitting over there with lots of embedded gain? If you ask them those questions, 9 times out of 10, they're going to describe exactly what is a long-term care event. So there's a question that I would recommend that you ask, you know, is your non-qualified, your client's non-qualified annuity where it should be? I've even asked it heard this way by some advisors to their clients. Is your non-qualified annuity the new kind or the old kind? Obviously, that really opens the door to any conversation, because, you know, your clients are going to say, well, what's the difference? So, and here's why I mention that. The Pension Protection Act really afforded some great opportunities when planning for long-term care by just 1035ing exchanging a non-qualified annuity that was non-HIPAA compliant, non-PPA, to a HIPAA compliant and PPA eligible annuity. And basically the slogan that I really like to use here is tax deferred to tax free for LTC. Again, a huge opportunity that many of us are overlooking when we're planning for long-term care scenarios. So what do I mean? Here's an existing non-qualified annuity. Obviously, you've got your cost basis. That's not taxable. That's the money that they put into that annuity. But over time, you've had a lots of gain that has happened in these contracts. That is all taxable to them when they take distributions. So if they just left their non-qualified annuity where it was at, any of those distributions would be taxable in that gain from that gain portion. So last in, first out. Excuse me. But just by doing a 1035 exchange into a HIPAA compliant, PPA eligible non-qualified annuity, now all of that amount becomes income tax free if used for long-term care expenses. And we can add our optional continuation of benefits rider, that same base and rider concept that I talked about at the very beginning of the presentation here. So let's look at another hypothetical here. Here's an indexed annuity care, one of our annuity care solutions that we have that's, again, a hypothetical here for age 70, female. And we're going to take a $150,000 annuity, and we are going to 1035 exchange that into a base and rider scenario. If we're looking at this, that $150,000 is coming over, and we're going to split that between both the base policy, which is payable for 24 months from the base policy, and then add that continuation of benefits rider that will continue that for as long as this female would ever need care. If we look at that, here's what that builds for this particular client: $47.31 on a monthly benefit, again, for as long as she would ever need care, just by 1035 exchanging that $150,000 non-qualified annuity from where she had it to a PPA eligible, and all of these, that taxable gain within that contract is all tax-free. Now, we can do this a little bit differently. We can beef up the monthly benefit amount by putting all of that $150,000 in the base policy and then annual paying the rider. So there's lots of ways that we can create these types of solutions. But here we're going to take that whole $150,000, put it in that base policy. We're going to create an annual premium then for the ongoing COB rider of $43.75. Why do we do that? Well, it beefs up or bolsters that monthly benefit that's available for her. So now we see that we're at $63.13 as a monthly benefit, and that will continue again for as long as she ever needs care, because we've created now this annual premium. So we are the first and only fixed income annuity out there with PPA benefits. And if I had a look at this, we can still create a single or a joint policy, and it depends on whether that, which structure it is, whether we've got a 24-month or a 30-month payout on the base itself. You can see the issue ages here from 40 to age 85. And again, either single or joint. It's a fixed indexed annuity, so all of the potential of the upside, but none of the downside risk. There's 5 particular solutions that they can use, all linked to the S&P 500 and a fixed account. So I guess that's one of the 5. So a number of solutions there. All are tax-free for long-term care unless, like I said earlier, we were using qualified money, then the gain in this portion would be just the gain of this particular annuity would be taxable. Can add that continuation of benefits rider. And it's a little bit different structure here. We've got the 2 times, 3 times, or my personal preference is always the lifetime solution here. Now, we can also do a base-only annuity. And there's some reasons that we would do that. And I wanted to walk through this quick scenario here. So let's take that same female, age 70, same $150,000, and just do a base only, getting rid of all that taxable gain, but just letting her use that over the 24 months. So again, we've got that $63.13 for her because all of that 1035 exchange went into the base. So she's only got that for the 24 months, or really as quickly as that monthly benefit would exhaust her cash value in that annuity. But it would all be tax-free, even the gain portion of that annuity. So why use this? Well, in our indexed annuity care, there's a guaranteed increase, kind of like a step up, if you will, for long-term care. Kind of acts like an inflation, so that the longer she has that annuity, the higher that monthly payout is going to be growing as well, just like the solution that they would take to tied to the S&P 500 for the annuity growth itself. So we've got growth in 2 pieces, both the LTC portion and the annuity. It gives her the ability to use that money penalty-free for 2 years. There's no telephone interview on a base only. And that may be one of the reasons that we want to do that as well. And then it's all tax-free if used for long-term care expenses. So why would we, what do I mean by no telephone interview? Well, we've got a simple 5-question knockout app here. And if they can answer no to all of these questions, we do an MIB check and a script check, and then it's accept or reject for base only. If we do add the COB rider, there will be a telephone interview, and that's largely for the cognitive portion. So we've got to check they're cognitively underwritable as well. So why base only? Again, maximize the LTC benefit, 5 knockout question app, and shed that taxable gain from that emergency fund situation. We've got that guaranteed step up again. We've got the growth potential with the guaranteed step up and their indexing choice based on the S&P 500 with no downside risk. And remember, we can always add the COB rider and inflation too if they wanted to do that. Now, one of the things that you may be thinking about, okay, so if we're going to 1035 exchange, there are rules that are in place, the NAIC has set, that it must be a like for like situation, right? Well, here's a way that we can still use a 1035 scenario, follow the like for like rules, but add a second spouse. It must be a spouse in this particular situation. It can't be domestic partnership or some of the other rules out there. It's truly got to be a spouse. That is the rules that we have to play by. But we can take a 1035 exchange of a singly owned annuity contract and exchange it over and still have it be singly owned. However, then we have the option to add an eligible person. So now, being that it's a spouse, we can add that person to this particular application so that they have availability to those funds for long-term care as well. So it's a great way to really, even in our annuity care solutions, to have a joint policy structure where 2 are drawing from those benefits. I did want to mention recurring premiums. I said that early on in this presentation today. So recurring premiums. We understand that not everybody's got a single premium amount. So we've got a pay to age 95, which is really our annual pay option, a 20 pay, a 10 pay, a 5 pay, and then obviously our single pay options as well. One other piece that I will give you as far as a planning option or choice with your clients is that we can single pay the base and annual pay the rider. So again, just ways of thinking about this. And again, any recurring premium, so that annual pay on the rider, let's say one of those individuals went on care or on claim, waiver of premium would kick in and would stop those annual premiums for the rider. So we're seeing a lot of that makeup here as well. Now, one last thing that I wanted to quickly throw in here, because we're in such a volatile time right now, with the market dropping, interest, rates are rising. There are lots of conservative clients out there that really want to make sure that they've got full access to their premiums that they would use for planning. So we also have a return of premium solution that I thought I would quickly show you. Issue ages 35 up to age 80 here. Again, we're going to see this funded through a lot of ways. But here's our hypothetical again for that male and female, both age 60. Now, our return of premium example, we only can use our 2% acceleration, and there is no lifetime. So no lifetime benefit for the return of premium. However, still creates a great solution here. So let's look at what we're going to use. So to a single premium of $189,000 will include both the base policy and the continuation of benefits rider. It creates a face amount of $300,000 that would be available to pay. And what does that buy them? $6,000 each on a monthly LTC benefit limit, or $72,000 annually. So what's great about that is, obviously, if they burn through their base policy, that $300,000 in terms of long-term care benefits, they have the continuation of benefits rider, so a total of $600,000 pool to draw from for both of them. So really good scenario here too. The nice thing about the return of premium, at any point in this contract, if they want that solution, they can get their money back at any point. They just surrender the policy. Obviously, they're not going to have any more long-term care coverage, but they surrender the policy. They get every penny back of their premium dollars that they put in. So very quickly, here's what they would get at the bank. If they just left that $189,000 sitting in, whatever account they had, a money market, checking, savings, CD, sitting in the bank, here's what they're going to get. They cash out, they have $189,000, right? They pass it on, so they don't ever need care and pass it on to their heirs. Well, that $189,000 will likely go through probate, probably not pass on the whole amount. If they live on it and need care, obviously, what are they going to have? Only that $189,000 to pay any of those expense bills. Now, if they did this return of premium scenario, here's what they have. Cash out, again, they get that, it's their money, it's always accessible. At any point in time, they get their 100% return of premium available back to them. They pass on, never use it. Now we've leveraged that $189,000, so we're actually passing on a tax-free death benefit to their heirs of $300,000. Goes directly to the family, skips probate. If they live on it, so they do need care, right? Now they have a total pool of $600,000, not just the $189,000. So again, those conservative clients out there, this market that we're in today, I think this fits very good. All right, so in conclusion here, look, qualified funds. Use one person's qualified funds to create a joint plan. That 10% bonus, actually should say 20, because it's now a 20% bonus. Spread out that taxation, R&D friendly, inherited IRAs, good things to look at. Again, one of the biggest opportunities I think that are out there is the 1035 existing non-qualified annuities. They're all PPA eligible with us here, so get rid of that, shed that taxable gain, if you will. Cash value life insurance, add that eligible person, so we can do a lot of 1035 exchanging here. Recurring premiums, 5, 10, 20 pay, an annual pay, which we call pay to 95, our waiver premium, and the annual pay, the continuation of benefits portion. So lots of ways that we can create these types of plans as well. And what sets us apart, again, our lifetime benefit offering, our joint second to die structure, our nearly 35 years of experience in this marketplace, and the financial strength of us as a mutual company. Now, you've got great folks there at IAMS, Justin and his team there at IAMS to really support you. But look, I love to connect with people on LinkedIn. If you have your phone, scan that QR code and we can link very quickly. But just wanted to let you know that we're available for you here as well. My internal partner, Johnny Mendez, is available as well, but I wanted to put our contact information up there. And with that, Justin, I want to say thanks to everybody for their valuable time and attention here. Really appreciate the opportunity to speak with everybody today.
Oh, thank you, Brent, and Johnny as well. I know he's helped me and a couple of our advisors with stuff while you were out, and you certainly much appreciated. I got to say today, I completely agree with you on the amount of annuities out there that could benefit from a 1035 into a product like this. We've got, with the Secure Act change coming up, I think our clients are going to hear more and more about annuities coming up, at least the word in their mouth, because the 401k statements or qualified plan statements are going to have to be coming up here next month. I believe it is at the end of this month. They've got to list out an annuity payout. And we run into, certainly on the phone, a lot of cases where somebody has an existing annuity and the direction they wanted to go with it originally has changed to now. Of course, they've taken care of a parent, and that's an important opportunity. But thank you. We'll appreciate you as always, Brent. I'm going to pull up some polling questions for us here. And if you would take a look at these, and will help us better follow up with you and get the material you need out your way. So would you like to see more information on the topic discussed today, especially the sales ideas? I know I would. I'm taking notes here, but Brent, I'm going to be circling back with you. More information on this topic today. If you can select if you'd like to see that, and we'll make sure that we allocate the right stuff out your way. Appreciate that. We'll give it a couple seconds here, and we'll close her out. Very good. Thank you for responding. And second, will you be contracting with OneAmerica? So if you're not already with OneAmerica, would you like to be contracted so we can get you those materials out, offer that solution to your clients that may have some of those annuities that they'd like to 1035, or maybe small business owners? If you're marketing to small business owners, that's another opportunity I saw in there. Brent, thank you for bringing that up. It can be a great option as a side benefit here, as companies are starting to reduce benefits to employees rather than add. Unfortunately, this could be something that they could benefit from for sure. Very good. Appreciate collecting responses here. Give it a couple more seconds. Thank you. And final one, if you already know you have a client in your mind, or you need to see an illustration to grasp a couple things, would you like to speak with one of our designers on our team here to get that illustration going? Indicate that, please, and then we'll make sure that, as an example, if I've got people to follow up on, I'll get out to you first. We'll get that illustration done for you and begin to have a discussion as we move forward. So, Brent, again, thank you very much for your time, as always. And if you guys need to reach out to Brent, definitely LinkedIn, his phone number there. If you need to reach out to us, our number's on the call here, and we'll be getting with you today and answering any questions you may have. So thanks again, Brent. Have a good day, and thank everybody for attending on this wonderful Monday morning. Have a great week.
Thank you all.